Hi, this is Andrew with Mock Till You Drop. In this video, I want to go over free cash flow to both the firm and to equity. I'm going to break down the components for each one and explain them in an intuitive way so that you're not just memorizing the formula for each. Now, this video is geared towards level 1 candidates, as you will find that there are a couple learning outcome statements that cover free cash flow. However, I think that free cash flow is a very important concept to understand because in level 2, there's entire reading on free cash flow. So first I'm going to explain free cash flow to the firm and to equity and the differences between the two. Then I'm going to go through an example for each one and explain the components. Lastly, I'm going to talk about what to expect in level 2 for free cash flow. One thing to keep in mind with free cash flow is that it is different from net income. Although net income is available to both bondholders and shareholders, it's only part of the equation. Both free cash flow to the firm and to equity make adjustments to net income for non-cash charges like depreciation, working capital investment, and fixed capital. However, free cash flow to the firm adds back interest costs because interest payments are available to bondholders, while free cash flow to equity adds net borrowings. The reason it's net borrowings is because if a firm receives a loan, that is cash available to shareholders. However, if they make payments on a loan, that is a reduction in cash. And I'll cover this in more detail in the following slides. So here's an example of the components that you'll typically use to calculate free cash flow. Net income is usually the starting point for determining free cash flow, although that may not always be the case, and I'll explain why in a little bit. But you can get that directly from the income statement. Now, non-cash charges, these are typically like depreciation. It can also be amortization. And the best way to think about this is, let's say you purchase a car for $15,000 and after 5 years it depreciates to $10,000. So the value of the car decreases by $5,000. However, you didn't pay out cash to anyone in the amount of $5,000. And this is the same concept for a firm. If it spends money on equipment and that equipment depreciates in value, they're not paying out cash for that loss in value. The firm is simply writing it off on its income statement to reduce net income. That's why non-cash charges are added back to net income. So if you're calculating free cash flow to the firm, you have to add back interest costs. Remember that free cash flow to the firm is available to both shareholders and bondholders. And as a bondholder, you receive interest on the firm's bonds. But because the interest cost is used to reduce income before taxes, the amount needs to be adjusted for the tax rate. And we'll show you how to do that calculation on the next slide. Fixed capital, you can think of this as money spent on equipment, so this will be reduced from free cash flow. Working capital investment is a little more complex when you get to level 2, as you would exclude certain items like cash and notes payable. However, for level 1, you can think of this as current assets minus current liabilities. For example, if a firm is spending money on inventories, this is a reduction in free cash flow. Lastly, we have net borrowings. If you remember from before, net borrowings is added to free cash flow to equity because it's cash from loans. However, it can also be subtracted from free cash flow if the loan repayment is greater than the money received. So let's go ahead and use the same example to solve for free cash flow to the firm. You can see in this calculation that we've included every component except for net borrowings, which is part of the free cash flow to equity equation. So from the last slide, we start with net income of 100. We add back the non-cash charges such as depreciation of 20. And we add back interest costs of 10, but make the adjustment for the tax rate because interest cost is a before tax item, so the amount added is 7. And then we subtract the fixed capital 50 and the working capital investment of 30 to get $47 as our answer for free cash flow to the firm. Now, let's see what happens if we were to include cash flow from operating activities into the problem. But before we do that, if you're getting value out of this video, please give it a like. Definitely helps out this channel. And if you want to see more videos like this, let us know in the comment section below. Also, don't forget to subscribe and hit that notification bell so you can get notified when we release new videos. Now, what if the problem looks something like this, where we're given cash flow from operating activities, or CFO? Notice how we no longer have the working capital investment in the problem, so we can't solve it like we did before. Well, CFO is simply the net income plus the non-cash charges minus the working capital investment. So we can swap out those three components for CFO, and we get this equation. Notice how the final answer is the same as before. Free cash flow to the firm equals $47. Now, one thing to keep in mind is that in this problem, we assume that CFO includes interest costs. However, under IFRS, if interest costs are not included in CFO, but in, let's say, financing activities, then we would not have to adjust for interest costs, as we show here. But for purposes of this video, we're going to keep things simple. So now we're going to solve for free cash flow to equity. Remember that free cash flow to equity does not add back interest costs, like in free cash flow to the firm, and it also adds net borrowings. So let's see what that looks like. So keep in mind that while you typically will be adding in net borrowings, that number could also be negative, and in that case you would subtract it from the equation. So let's say you're given an increase in borrowings of $50 but repayment of debt of $60. Then you'd have a negative $10, which would be subtracted from the equation. It's not common, but just keep it in mind. So solving for free cash flow to equity, we get $80. Now let's see what happens when we include CFO in the problem, just like we did for free cash flow to the firm. So we're going to use the same information as we did for free cash flow to the firm. Again, CFO is simply the net income plus the non-cash charges minus the working capital investment. So we swap out those three components for CFO, and we get this equation. Notice how the final answer is the same as before. Free cash flow to equity equals $80. So for level 2, you're going to learn how to compute the basic calculations for free cash flow, just like you did in level 1. You'll learn not only how to calculate from CFO, but also from EBIT and EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Level 2 also goes into a lot more depth with using free cash flows for evaluating a firm. So that's why I mentioned earlier in this video that level 1 really sets a foundation for understanding free cash flows so that you're better prepared once you start that section in level 2. Alright, so I hope this video was helpful. Again, let me know what you think in the comment section, and if you'd like to see more videos like this one. Thanks for watching.